Hello, and welcome to The Brief Insight, your go to podcast for breaking down the latest trends, research, and policies shaping our world. Whether you're passionate about sustainability, global economics, or emerging innovations, this is where we simplify complex ideas to keep you informed and inspired. If you enjoy what you hear, don't forget to like this episode, subscribe to our channel, and share it with anyone looking for insights that matter. We're here every Monday and Friday, so hit that notification bell to stay updated. Your support helps us grow and continue bringing you sharp, relevant content that sparks conversation. Thank you for tuning into The Brief Insight. Now let's dive into today's topic.
So for half a century, U.S. Treasury bonds have been this unquestioned bedrock of global wealth. Like if you were a sovereign nation or some massive pension fund, the U.S. dollar was your ultimate safe harbor.
Right. The absolute baseline.
Exactly. But today, for literally the first time in modern history, official foreign central bank holdings of fiscal gold have actually reached near parity with foreign holdings of U.S. debt.
Which is just a massive shift.
It's wild. So the absolute anchor of the global financial system is quietly, being forced to share the stage. So welcome to the deep dive. Today, we are taking a hard look at the shifting tectonic plates of global finance.
Yeah, and it's a huge topic.
It really is. And our mission today is to help you, the listener, understand if the world is structurally dumping the U.S. dollar or if central banks are simply buying incredibly expensive insurance against a new era of geopolitical chaos.
Right, because it really is a profound shift in market architecture. I mean, for decades, the financial dominance of the United States was a mathematical constant in every economic model.
Always zero risk.
Exactly. But when we look at the data coming in today, that constant is starting to look a lot more like a variable.
And to figure out exactly how that variable is changing, we have a really dense stack of research to unpack today. So we're looking at a broad market analysis from the Anderson Institute, some market commentary from the Atlantic Council, a geopolitical piece from the SCMP, some really intensive economic modeling from the Yale Budget Lab.
That one is fascinating, by the way.
Oh, it's so good. And finally, a heavily data-driven preprint study on how gold is just completely reshaping global reserves.
Yeah, and to really grasp the magnitude of what these sources are telling us, we should probably start with the immediate observable symptoms of the markets right now.
Right.
Because we are seeing a distinct weakening of the dollar, but we aren't seeing total panic. It's a very specific kind of market stress.
Yeah, and the Atlantic Council lays out those symptoms pretty clearly. They note that the U.S. dollar has dropped to a 4-year low. It's slid more than 10% since the start of the current presidential administration in 2025.
Right.
And backing that up, the SCMP points out that China's stockpile of U.S. treasuries hit a 17-year low in late 2025. So on the surface, taking those two data points together, it looks like this coordinated rush for the exits.
It does. It really does look like that. But then you look at the equities market and the bond yields, and the narrative just completely fractures. I mean, global investors are not executing massive capital flight away from U.S. assets.
Okay, let's unpack this because this is the paradox that really stands out to me.
Yeah.
If foreign governments are dialing back their treasury holdings and the dollar is sliding, why is the U.S. stock market hitting all-time highs?
Yeah, it's a great question.
I mean, the S&P 500 is up 15%. Furthermore, the yield on 10-year treasury bonds is actually lower right now. And, lower yields mathematically mean bond prices are high, which signals strong, enduring demand.
Exactly.
So it feels like investors are buying massive amounts of fire insurance while simultaneously investing their life savings in the match factory.
That is a perfect way to put it.
Right.
And the Atlantic Council report categorizes this behavior very specifically as hedging America rather than selling America.
Hedging America.
Right. Investors are pricing in what analysts term policy chaos.
Okay.
You have sudden, unpredictable rumblings in the news, like recent discussions about the U.S. potentially trying to buy Greenland again.
Oh, right.
Or market fears that the new Fed chair nominee, Kevin Warsh, might be pressured politically to cut interest rates prematurely.
Wow. Okay.
But that policy chaos doesn't necessarily kill the stock market in the short term. In fact, A weakening dollar mechanically boosts U.S. corporate profits.
Wait, because U.S. multinationals sell their products overseas, right? And when they convert those foreign euros or yen back into a weaker U.S. dollar, it just looks like they made more money on paper.
That is exactly the mechanism. Yeah. Their foreign earnings translate to higher dollar figures, which drives up stock valuations. So the stock market high is actually masking the underlying structural anxiety.
Oh.
Investors are adjusting their portfolios for wild volatility, but they aren't fleeing the U.S. entirely because the underlying engine is still generating returns.
But returns and stability are two very different things.
Completely.
If we want to understand the long-term threat to the dollar status, we have to look past the stock market highs and examine the unpriced structural risks that are building up in the system.
Which is exactly the diagnosis the Yale Budget Lab focuses on.
Yeah.
They look at the sheer asymmetry of U.S. global influence. The United States represents just 4% of the world's population, yet it accounts for 16% of global GDP, holds 58% of all foreign exchange reserves, and is involved in an astonishing 89% of all foreign exchange transactions globally.
Yeah, it's just staggering. 89%.
It is.
And because of that absolute dominance, the Yale researchers point out this really fascinating flaw in how economists build their models.
Right.
Like, when you calculate the valuation of any global asset, you use the U.S. 10-year Treasury yield as the literal definition of the risk-free rate.
Right, the baseline.
And because of that, models automatically assume the U.S. country risk premium is exactly 0%.
And let's define what that premium actually does mechanically.
Yeah, please.
So country risk premium, or CRP, is the additional yield investors demand to compensate them for the risk of parking their capital in a specific country.
Okay.
Like, if you invest in an emerging market with a history of, say, regime changes, you demand a much higher interest rate to take on that political risk. But the U.S. has always been treated as the ultimate baseline, zero risk.
But the Yale Budget Lab argues that a 0% assumption is mathematically obsolete now.
Totally obsolete.
They pulled data from major governance indices like VDEM, the International Country Risk Guide, and the World Bank's Worldwide Governance Indicators.
Yeah.
And all of these metrics show a measurable, steady deterioration in U.S. institutional stability, particularly observing the trend line between 2016 and 2020.
Right.
So the researchers basically bypassed the traditional models and calculated what the U.S. risk premium should be right now. And they identified a shadow risk premium sitting between 25 and 35 basis points.
Yeah, and a basis point is just 1/100th of a percentage point. So 25 basis points is 1/4%.
Which sounds tiny.
Exactly. In the world of retail banking, 1/4% sounds like a rounding error. But in global sovereign debt, it is a tectonic shift.
And the Yale team modeled a scenario to show just how catastrophic a sudden repricing of that risk could be.
This part is scary.
It really is. They looked at the UK right after the Brexit vote, where the British risk premium suddenly gapped up to 88 basis points. And they asked the question, well, what happens to the American economy if global markets suddenly wake up tomorrow and assign the U.S. an 88 basis point risk premium?
Yeah.
The result is a 1% smaller real GDP and $50,000 less equity wealth per American household after 10 years.
We should probably walk through the actual mechanics of how that wealth gets destroyed.
Yeah, let's do that.
So if the global market demands an extra 88 basis points to hold U.S. sovereign debt, the U.S. Treasury has to offer higher interest rates. Because Treasury yields dictate the floor for all other borrowing, every single corporation in America suddenly faces higher borrowing costs.
Right, their cost of capital just goes up.
Exactly. The weighted average cost of capital spikes. So a mid-sized manufacturing company that was planning to build a new factory, they look at the numbers and realize the math no longer works.
Wow.
So they cancel the expansion, they freeze hiring, multiply that across the entire economy, corporate earnings contract, stock multipliers shrink, and equity valuations plummet.
That is wild.
Yeah, that is how a shift in abstract sovereign risk drains $50,000 from a family's brokerage account over a decade.
And the crazy part is it doesn't even require an actual default to trigger this repricing.
Not at all.
The Yale piece points back to the 2011 debt ceiling crisis. The U.S. didn't default, it paid its bills, but the political brinkmanship alone prompted Standard & Poor's to downgrade the U.S. credit rating. And that singular downgrade, based purely on institutional chaos, wiped out $1.7 trillion in S&P 500 market capitalization almost overnight.
It's staggering.
Yet, despite that historical precedent, a recent States United survey found that 40% of institutional investors do not factor U.S. political risk into their investment models at all.
They are running their portfolios with a massive systemic blind spot.
Here's where it gets really interesting to me. It's like the global economy is driving a Volvo.
Okay.
For decades, we knew it was the safest car on the road. But the latest crash tests just downgraded it to a golf cart, and yet investors are still driving it 90 miles an hour down the highway without a seatbelt.
That is a great analogy. And for the drivers who have read the crash test report and want to buy a different car, well, they immediately run into a profound structural problem. Which brings us to the Anderson Institute's analysis of fiat currency alternatives. If you manage a sovereign wealth fund and decide U.S. political risk is too high, you have to move your capital to another fiat currency. But the math simply does not support a mass migration.
So what does this all mean for, the listener's pension fund? Because if I'm managing $1 trillion, I can't just boycott treasuries, right?
No, you really can't.
It sounds like there literally aren't enough financial parking spaces in Europe or Japan to fit all the world's money.
That's exactly the issue.
Hmm.
The U.S. Treasury market is roughly a $30 trillion behemoth.
Yeah.
Global savings require extreme scale and deep liquidity.
Right.
If you are moving $100 billion, you need a market where you can execute that trade without the sheer size of your order moving the price against you.
And deep liquidity means narrow bid-ask spreads and the capacity to absorb massive inflows.
Precisely. And when we look at the alternatives, they just fail on those metrics. Take Europe. The Eurozone offers about $13 trillion in sovereign debt, backed by strong rule of law. The issue there is fragmentation.
Yeah, the sources mention ongoing discussions about a unified €1 trillion debt issuance to create a true pan-European safe asset.
That would help, sure, but currently that $13 trillion is split across sovereign lines. German bunds and Italian BTPs carry entirely different risk profiles.
Right.
During a crisis, they do not behave as a unified safe asset. They diverge.
Okay, so then there is Japan, sitting on a $7.5 trillion bond market. But it's overwhelmingly owned by domestic investors, specifically the Bank of Japan, which heavily manipulates the yield curve.
Yeah.
And the Anderson Institute flags a massive systemic risk regarding Japan, which is the yen carry trade.
Oh, this is a critical mechanism to understand. The Bank of Japan has kept interest rates near zero or even negative for a very long time.
Right, so is that the trade where global hedge funds basically borrow yen for practically zero interest, convert it into dollars, and pump it into high-yield U.S. tech stocks or emerging market bonds?
That is exactly how it works. They are shorting the yen to buy higher-yielding global assets.
Yeah.
And it's estimated to be a $1 trillion trade.
Wow.
The danger is the unwind. If Japan decides to normalize its monetary policy to make its bonds more attractive to the rest of the world, Japanese interest rates will rise.
Right.
Suddenly, the cost to service all that borrowed yen spikes.
So those hedge funds just get margin called?
Boom, margin called. And to cover their yen-denominated debt, they are forced to sell their global assets en masse. They liquidate U.S. tech stocks, they liquidate European bonds, just to buy back the yen.
That sounds like a disaster.
It would be. An abrupt unwind of the carry trade wouldn't provide a safe harbor. It would trigger a massive global liquidity crisis.
Which firmly crosses Japan off the list for parking massive amounts of capital. So what about China? They have a $6 trillion market, but the Anderson analysis notes the heavy legal opacity and capital controls. You can't confidently repatriate your capital in a crisis.
Right.
And the emerging markets universe, which is roughly $8 to $9 trillion, is utilized by funds for generating yield, not as a primary store of safety.
The structural reality is just stark. The fiat alternatives are either too fragmented, too illiquid, or too heavily manipulated to absorb global savings at scale.
So central banks find themselves backed into a corner. They recognize the rising shadow risk premium of the U.S. dollar, but the alternative fiat parking garages are either compact-only spots or they're structurally unsound.
Exactly.
But central banks still feel an existential urgency to diversify. And this is where the dynamic shifts from traditional finance to raw geopolitics.
Yeah, because they can't effectively pivot to another fiat currency, they're reviving the oldest, most foundational asset in human history.
Enter the golden elephant in the room. We're looking at the preprint study on de-dollarization, and the data paints a picture of a historic pivot to physical gold. Over the last quarter century, the U.S. dollar's share of global foreign exchange reserves has steadily tumbled from 71.01% in 1999 down to 57.74% in 2025.
While the dollar share has eroded, global official gold holdings have surged to $3.909 trillion.
Wow.
For the first time in the modern financial era, foreign central banks hold virtually the same amount of wealth in physical gold as they do in U.S. Treasuries, which currently sit at $3.920 trillion.
The gap between the two is literally a rounding error.
Yeah.
But what stands out in the preprint data is that this isn't a uniform global buying spree, right? It is highly concentrated among a specific block of nations.
Very concentrated.
Russia has amassed 1,894 tons, China holds 1,807 tons, Turkey has 705 tons, and India holds 523 tons. India even executed a highly symbolic move in 2024, repatriating 100 tons of its gold from the vaults of the Bank of England back to domestic soil.
And the driving force behind this specific concentration is the fear of sanctions. The United States has increasingly utilized the dollar network as a geopolitical weapon.
Right.
We saw this executed aggressively against Russia and Iran.
The Iranian case is particularly revealing. The U.S. implemented a maximum pressure campaign that was engineered to essentially starve the Iranian economy of dollars.
Yeah.
And the mechanism was brutal. It caused the Iranian rial to collapse to 1.4 million per single U.S. dollar, which subsequently triggered systemic bank failures inside the country.
And other central banks, especially in the global south, watched the Iranian economy implode and realized that their own heavy reliance on dollar reserves was a critical national security vulnerability.
I mean, of course.
If you conduct foreign policy that runs counter to Washington's interests, your foreign reserves could be frozen, seized, or rendered completely illiquid overnight.
That fear of weaponization perfectly explains the rush toward an asset that operates outside the fiat banking system. But the preprint study goes much further than just analyzing the volume of gold purchases.
It does.
The researchers utilized a highly complex mathematical model to analyze how gold actually behaves in a portfolio. They ran a quantile-on-quantile regression.
It is a phenomenal analytical tool because it corrects a massive flaw in how we usually look at market data.
How so?
Well, a standard regression takes thousands of data points over decades and spits out an average. But an average can be deeply misleading. It's like measuring the average temperature of a hospital. It doesn't tell you the difference between the burn ward and the freezer.
That makes total sense. So a quantile-on-quantile regression maps specific extremes against each other.
Exactly.
It isolates how gold performs when the stock market is crashing versus how it performs when the stock market is booming, rather than just blending it all into an average Tuesday.
And what the QQ regression revealed is that gold's performance is distinctly U-shaped. This entirely shatters the conventional wisdom that gold is a constant, everyday hedge against volatility.
Wait, so gold isn't this magical shield that works all the time?
No.
You're telling me it only works when the sky is literally falling or when everyone is getting rich? That completely shatters the advice I've always heard about holding gold just for everyday stability.
Yeah, the data shows that gold only acts as a safe haven on the extreme left side of the U during severe systemic stock market crashes.
Right.
Or, conversely, it surges on the extreme right side of the U, moving alongside equities during massive, exceptional bull markets.
Right.
In the vast middle of that U shape, during normal, everyday market conditions, gold is practically dormant.
Wow.
It proves that gold is a highly regime-dependent asset. You don't hold it for daily stability. You hold it for the tail risks.
But the study captured a recent event where even that U-shaped model completely broke down, didn't it?
It did. During the 2026 Iran escalation, the geopolitical stress reached such an extreme level that gold surged past $5,500 an ounce. But simultaneously, the U.S. dollar also strengthened aggressively.
Because the market was hoarding both.
Exactly. Investors were panic buying the ultimate hard asset gold while simultaneously grasping for the ultimate liquid asset, the dollar.
That's fascinating.
It demonstrated a profound underlying fear of fiat currency devaluation, but it also proved that in the absolute depths of a crisis, global institutions still require dollar liquidity to function.
Which brings a really crucial nuance to this entire discussion. The preprint study notes that 76% of central banks are currently buying gold.
Yeah.
But for the vast majority of them, this is not some ideological crusade to destroy the U.S. dollar. It is a highly rational mathematical exercise in long-term portfolio diversification.
Precisely. They are diluting their reliance on the dollar because the shadow risk premium is rising and the threat of sanctions is very real, but they aren't abandoning the U.S. system entirely.
Right. The US dollar is not collapsing. It remains the dominant transaction currency of the world.
Yeah.
But it is no longer the solitary, unquestioned anchor.
No.
Central banks are building a multipolar reserve system where gold serves as the ultimate sanction-proof collateral.
That's exactly what's happening.
So, to bring all of this complex financial architecture down to earth, why should you, the listener, care about shadow risk premiums, quantile regressions, or central banks repatriating physical gold?
Yeah, what does it matter?
You should care because these macro shifts directly dictate the cost of your everyday life. If foreign governments and institutional investors begin treating U.S. debt as a slightly riskier asset, if they demand that extra 25 to 35 basis points of yield, the U.S. government has to spend significantly more money just to service its national debt.
Which forces interest rates up across the board.
Exactly. It means higher mortgage rates when you try to buy a home. It means auto loans become more expensive. It means the companies in your 401k face higher borrowing costs, which stifles their growth and directly impacts your retirement timeline.
Right.
Ultimately, when the world demands a higher premium to hold the dollar, it slowly but inevitably erodes the purchasing power of the money sitting in your wallet today.
The structural shifts happening at the sovereign level always trickle down to the retail level.
Always.
And this dynamic introduces a fascinating geopolitical question, something for you to mull over long after this deep dive ends.
What's that?
Well, we have established that the weaponization of the dollar is driving nations in the global south to hoard physical gold and experiment with alternative currency networks.
Right.
But what happens if they succeed? If these nations successfully insulate their economies, if they build a robust, parallel financial system that is entirely immune to U.S. sanctions, what happens to the global influence of the United States?
Wow. Yeah.
For the last several decades, the U.S. has relied heavily on financial sanctions as a primary, bloodless tool to enforce international norms and deter aggression.
Right. Instead of military force.
Exactly. If the United States effectively loses its financial weaponry because the targets are fully insulated by gold, will the world become more prone to actual physical military conflicts simply because the economic deterrents no longer work?
Man. It fundamentally changes the calculus of global stability.
It really does.
The concrete safe harbor we started with isn't draining overnight. But the biggest ships in the world are quietly building their own life rafts, and they are using gold to do it. Thanks for joining us on this deep dive. We'll see you next time.